Hi, I'm James.
And I'm Antony.
And this is Words and Numbers.
Today, as this podcast is released, that's Wednesday, March 22nd, you and I are hosting an evening with James and Ant. We've done this several times in the past, and the fans seem to like it, though I don't think we've done it for about a year or more.
Yeah, it's been a long time.
There's no format to the evening. It's just James and I on a Zoom call along with a bunch of fans. Typically, I don't know what, maybe 20 people show up, 25 people. We talk about whatever comes up. No doubt the banking meltdown will be a hot topic, but this is kind of more of an opportunity for us all to interact, and it seems actually that our fans enjoy meeting each other as much as they do meeting us.
You should probably stop calling them fans and start calling them listeners. That seems so much better. I don't think we have fans. What the hell's wrong with you?
I have fans, James.
No, you absolutely don't. And I'm going to just be sitting outside smoking a cigar. So, I encourage you to join me in that particular behavior. Get your own cigar and go outside at your own place and smoke.
Yeah, it's kind of a BYOB type thing.
There will be a giveaway. There will be a contest.
Oh, that's right. We've got lots of stuff to give away. What do we have? We've got mugs. We've got books.
I was sent a watch that I did not order. This should have been a dream come true for me. Was it Omega Seamaster? No. Was it a Rolex Submariner? No. It was some god-awful Italian thing that was actually made in China. It's the worst watch I've ever seen. So we're going to give it away. Along with that watch will come a James Harrigan gift pack, in which
is a bunch of other things that nobody wants.
No, that's exactly right. I go through the entire house and find a bunch of crap that I just want to get the hell out of here. And I mail it off to some new person who I've never actually met.
It's cheaper than paying the garbage man, right?
It absolutely is. So come on by, get your entry in for the gigantic giveaway. We might throw something in with that giveaway that's worth having. We'll see.
The event is Wednesday, March 22nd. We'll start at 9 p.m. Eastern, and you need a link to get in. To get the link, send me an email at wordsandnumberspodcast@gmail.com.
I wanted to talk about something involving us as well. It's March 20th, Ant, 2023. Does that date ring a bell to you?
March 20th, no.
It was 3 years ago today that we launched our book tour.
Oh, my God, of course, yes.
And we went out on the road only to be turned away because of the gigantic COVID problem.
That's right. In fact, you've got a picture you took.
That's right.
We were at some hotel in Charlotte. It was supposed to be a book signing. The whole thing was called off, but it was called off, I think, when we were in the air on the way there. So I'm standing in an empty room.
It might have been called off as we checked into the hotel.
Yeah.
That's how things were working there for a while. I work at AIER, and I have to edit the pieces that come in. The AIER authors are still writing about COVID every single week. It's like an omnipresence in my life. But when you look back, it was, on the one hand, 3 long years ago, and on the other hand, just 3 years ago.
Yeah.
I can't really figure out in my head which of those two time frames makes more sense.
I actually had occasion to look up some COVID statistics just yesterday. A friend of mine is in Scotland and got COVID. And he said everybody here, well, not everybody, but many people here have it. So I looked up the numbers to see what's been going on worldwide with COVID cases since early 2022 when we stopped thinking about it. And it's been up and down. There have been peaks, lots of COVID cases, very few COVID cases. It just hasn't been in the news.
Yeah, and it's probably best that way. It turns into something not unlike the flu.
Yeah, it comes, it goes.
Anyway, you would think that would lead us into the foolishness of the week, and it does, but you would think that the foolishness of the week would be about COVID or something, and it's not. It's about a train in California.
Yeah, whatever it is, the
yes,
whatever
train.
It
is, that's
that
right.
Very fast, very expensive train.
It's not the commuter train, it's a metro train. Come to find out, there are metro trains in Los Angeles. Ridership on the metro trains is not only down, it's down drastically. It's down by like a third, a half, 2/3 in some cases, because the trains have become places where people go to do drugs and commit crimes. Apparently, that's just fine with the powers that be. Some 22 people have died recently on the trains.
You're kidding.
Mostly of overdoses, which seems crazy. In January, for example, ridership on one line was down 30%, on another 56%. on a $2.1 billion line, the so-called Crenshaw line, that officials, quote, tout as a high spot with little crime. There were fewer than 2,100 average weekday boardings that month. You want to start doing some math, let's do 2,100 times 12 and divide $2.1 billion by the number you just came up with.
As skeptical as I am, and I imagine you are, of the police, if you're not enforcing the law, this is what you get.
That's right. And you might be able to get away with this in small-town rural Ohio.
Sure.
You go to the second largest city in the United States, you're probably going to have some problems if you don't have a pretty heavy police presence on something like public transportation. But whatever these people in LA are doing, they are not doing it correctly.
Once more, California is an example to the rest of us. For one-stop shopping for all things James and Ant, visit our website, wordsandnumbers.org. If you're a full-time college student looking for something educational, fun, and free, apply to join me and James and several faculty who have appeared on Words and Numbers at the inaugural summer seminar on the theory and practice of classical liberalism. The week-long seminar is hosted by the Stevenson Institute at Wabash University and will be held June 5th through the 10th. There's no charge, and meals and lodging are provided. To apply, see the link in the show notes. Peter Earle joins us this week. Pete is an economist at the American Institute for Economic Research. He spent over 20 years as a trader and analyst at a number of securities firms and hedge funds in the New York City area. His research focuses on financial markets, monetary policy, and problems in economic measurement. He has been quoted by the Wall Street Journal, Bloomberg, Reuters, CNBC, NPR, and numerous other media outlets. Pete holds an MA in Applied Economics from the American University, an MBA in Finance, and a BS in Engineering from the United States Military Academy at West Point. Pete, welcome to Words and Numbers.
Great to be here. Thanks for having me.
It takes the crash of a bank to get you out of the woodwork.
Right.
But that's what we're looking at. We've got a bank that has utterly failed, and the government has stepped in to, quote unquote, fix that. Antony and I have been getting a lot of emails asking us to explain what is going on, and yet the two of us are utterly incompetent to do that. So we thought maybe you could come and bail us out of this.
James, you've been in my office here at AIR, and on the wall of my office, I have a poster. I've had it for about 25 years, since I started as a trader in the mid-90s, and it's got a tornado on it. And it says, when the winds of change blow hard enough, even the most trivial things can turn into deadly projectiles. And that's probably the foremost lesson I learned as a trader for many years. And I think that's a good way to talk about what happened at Silicon Valley Bank. It's the second biggest bank failure in history. Opened about 40 years ago. It's got a huge bunch of the venture capital firms in Palo Alto, Sunnyvale, Cupertino, all that. Like lots of banks, it found itself in a really great position early in the pandemic. In the early COVID lockdowns, there was this consumption binge, right? You had stimulus checks, you had all these programs like the payment protection plan, all that. Also, people sitting at home and they're subscribing to Netflix and they're doing all these other things. So what happens is the coffers of many banks swelled up. In fact, between the end of 2019 and 2022, the $50 billion in deposits at SVB rose to about $190 billion. That's a pretty big leap. And so to put money to work, which of course is what banks do, they took some of those deposits and they bought what looked safe, which are long-term securities. They bought 30-year US Treasury bonds. They bought 20 and 30-year agency securities, mostly mortgages and that kind of thing. And between 2020 and 2021, their Treasury holdings came to about $100 billion in market value. It's a pretty big book. As interest rates were lowered by the Fed, there's less and less that's safe that's paying anything reasonable. And you're not going to get a bank like SVB or any other buying, a portfolio of stocks or that kind of thing. So they figured that this was a good place to put their money. Unfortunately, they were buying at really high prices because with rates low, of course, the price of the bonds are going to be high. But there's another factor too, and that is that the cost basis on their deposits was about 0.14%. So when you think about it, if 0.14 is your expenditure, right, you're paying on deposits, and you're taking in that measly 1.87 or 2%, that's a business. You can make money like that.
For our listeners, so the bank is receiving 2% plus or minus on Treasury bills, turning around and paying 0.1% to people who have deposited their money in the bank, and then walking away with the extra as profit.
Solid business. That's
okay.
Right. That's the basic situation. And that's the way it goes for a while. And then you have inflation early in 2021, even before people start seeing it. It starts in February, March 2021, gets higher and higher. And then you have the Russian invasion of Ukraine in February 2022. Year over year, CPI headline hits 7.9%, and the Fed starts raising rates. Not only do they begin raising rates, though, but they begin raising it in these three huge jumbo moves, these 75 basis point moves. And, a year later, we've got rates at 4.5%. Since about 2000, I think more than 15 years, we've had rates that have been less than half of 1%. And by the time we reach December 2022 and January 2023, for the first time in decades, we actually have negative monetary growth. We actually have M1 and M2 shrinking. As this happens, bond prices are just cratering. Long-term U.S. Treasuries had their worst year on record. I think you have to go back to the War of 1812 or before that to have a worse year in the prices of long-term Treasury bonds. Most of them lost about 40% of their value.
What I'm looking to clear up here in our listeners' minds is something you just said, that the Treasury bonds lost a third of their value.
Yeah.
Because people understand that Treasury bonds are supposed to be safe. How can it be that they lose a third of their value?
Well, you said 40%, didn't you?
Yeah, I believe the number is 39.2% on average for bonds more than, say, 25 years to maturity.
Good God.
So in the fixed income markets, whether we're talking about corporate bonds or treasuries, there's an inverse relationship between interest rates and bond prices. As the Fed was lowering rates, the prices of these bonds were rising up. And so what that means is that for all these banks, including SVB, that were buying treasury bonds with rates that low, they were buying these bonds at all-time highs, essentially. And the only way for rates to go at that point was up. And therefore, the only way for the market price of the bonds was to go down.
Because the price of bonds and the interest rate always move in opposite directions.
Right. They were really top-ticking the market with those purchases. Now, you might say, and you'd be right, didn't they think rates were ever going to go up? And I would say yes. However, what they didn't think is that they were going to go up that quickly. I think they thought rates would slowly rise, quarter basis point, every couple of months, every half a year, and that they would slowly shift their average maturity of their book to other securities. They could ride out the rise in interest rates, but that's not what happened. There's a situation that arises here called a duration gap. And what that means, there's a mismatch between the assets and liabilities that takes the form of an interest rate risk. Let's say the average rate that they were being paid, a fixed rate on those long-term bonds that they owned at SVB, was about 1.87%. They bought that locking in these rates of, say, 2%. The problem is that the assets are fixed, while the liabilities are variable. The deposits are variable, right? So the Fed starts raising rates. When that starts, the cost of deposits, like I said, is about 0.14%. They're receiving about 1.872%. That's a business. You can live on that. You can do that, especially at the scale that they were doing it. By the end of 2022, the cost of deposits had gone from 0.14% to 2.33%.
Right.
Now you're taking in 1.87%, you're paying out 2.33%. This is a duration gap, and this is a very dangerous situation, especially for banks. But as they say in the infomercials, wait, there's more. SVB is a regional bank. Regional banks are notoriously undiversified. That stands to reason because you have geographic situations, you have industries in an area. If you think of a regional bank in Detroit, maybe not now, but 50 years ago, you would have had exposure to a lot of automotive firms and tire firms, light industry, that kind of thing. But SVB is about as diverse as a 20-piece bag of chicken McNuggets. It's got two things. It's got tech firms and it's got wineries or vineyards, right? So it's not just that it's a tech-heavy depositor base, but startup tech firms, which means some of these firms have a very high burn rate. It means that they are moving money around. It's a very unreliable base of deposits. Even worse, you're talking about tech firms where you have these hundreds or thousands of firms that are basically in the portfolios of 15 to 25 large venture capital firms. So there are these large firms out there that can tell them what to do, say, move money, do this, do that. So there's a potential for sort of what I would call herding behavior, herding dynamics within this depositor base. So sure enough, throughout 2022, you have interest rates rising, reopening speed up. Suddenly people are not doing all the Netflix ordering and all that stuff anymore. We're already getting words about layoffs in these high-tech firms. And this burst of activity, which these tech firms had enjoyed for 2 years, starts to subside. In the middle of 2022, we have a brief recession. Throughout the fall of 2022, we have news about these layoffs. Throughout that time, about $30 billion in deposits left SVB. you have paper losses on the long end with interest rates rising and the bonds falling in price, and you have liabilities flowing out on the short end. Now, the way SVB could compete to keep those deposits, if they could, which it's not sure they could because of the unique nature of their depositor base, would be, of course, to pay more interest, to pay more on accounts. What that does is that makes the spread between that 1.87 or 2% of the bonds and what they have to pay to depositors even greater. It's a problem.
Right.
Now, Pete, can we stop here for just a second? You said earlier that they had 190 billion in deposits, and then you just said 30 billion got withdrawn.
Mm-hmm. Yep.
That's a big chunk.
It's a huge chunk. Absolutely.
So why so much? Why are people pulling their money out?
Well, partially because, again, a lot of these VC firms, I guess they were cutting losses on some of these portfolio companies. Some of them weren't doing the kind of business they were doing early on. There's a whole bunch of factors. Revenues are falling for some of these firms because people are going back to work. They're starting to tighten their budgets. We have inflation rising, so people are starting to unsubscribe from Netflix and things like that. So there's a whole bunch of factors here. This is the beginning of the contraction of the economy. And so you have a lot of these deposits that are leaving the bank.
What you're describing is on the banking, the finance side of what we were all reading in the headlines a couple of months ago or even earlier about tech firms having massive layoffs.
That's it. That's exactly right.
Okay.
As that's happening, deposits are leaving the bank.
Yep.
And also, the size of deposits are not growing in some cases. And sometimes firms move and they bring their capital with them, whatever. So there's all that. Paper losses on the long end with those bonds and agency securities, liabilities flowing out the front end. Depositor base is shrinking. This takes us up to the present day. Deposits continue to flow out with rates getting higher. SVB starts to notice that the deposits are flowing out at a rate that if it continues, they kind of draw a straight line. They say, wow, this is fractional reserve banking. We don't have enough reserves to meet these deposits if they accelerate. So what they decide to do, and this is, again, I won't get into too much on this. All of these bonds they have, you have to keep them in two separate accounts. One is called the HTM account. That's held to maturity. Those are bonds you're basically saying, I'm going to hold on to these until they mature.
And these are treasury bonds you're talking about?
Treasury bonds and agencies, yeah.
Okay.
And then on the other side, you have the AFS account. That's assets for sale. Those are also long-term treasuries and all that. And those are securities that you are saying, if I need to sell these to raise money, I will. Long-term treasury bonds and some of these long-term agencies are very illiquid. These are bonds that have a 30-year maturity, in many cases, 25, 30 years. There's not a lot of market participants out there buying and selling these things. For the most part, a lot of the entities that buy these 30-year securities hold on to them till maturity.
Mm-hmm.
And I'm thinking in this case of pension funds, insurance funds, that kind of thing. So what that means is they're already sitting on huge losses. When they go into the market to sell them, they're going to take another % or 2 or 3 because of illiquidity. Basically, that's market impact. The loss in just that very first liquidation, a bunch of long-dated securities, I believe they were trying to sell $21 billion worth of treasuries, was approaching about $2 billion.
Wow.
That's a huge hit. Anybody watching that starts to panic. Then there's a regulatory filing by SVB where they say, hey, we're going to do a $2.25 or $2.5 billion stock offering to raise more capital. This is the origin of the fear. Deposits are leaving SBV. Interest rates are still rising. Disinflation is slowing, right? So the Fed will probably have to raise rates even more. We're starting to see that just the last 2 months. Long-dated treasuries are going to get hammered even worse than they have been. The question is, can SVB sell enough treasuries to meet the outflow of deposits, considering the beating they've taken on this small initial attempt to raise money? That's the question.
The tech sector is in decline. Tech companies are pulling money out of SVB. SVB has to come up with the cash to give them the money that they're pulling out, so it's got to sell treasuries. I want to pause there for a second and go back to this question about risk. Treasuries are understood to be riskless, but that's provided you hold them all the way to maturity. You hold it the full 30 years, you get your money back. Am I correct here? If like SVB needs its money now, it may have to sell these treasuries at a loss, and that's where the risk comes in.
So this riskless idea, first of all, it's a little bit overblown. And second of all, way more importantly, the idea of this riskless security that the government issues is very contextual. All they tell you is going to get your money back. It doesn't mean you're going to get money of the same value back.
Yeah, the purchasing power, right.
You get highly inflated money back.
Right.
If you have to sell it in a hurry, especially if it's illiquid, which many of those long-term securities are, and take a loss. In the short end of the market, where you're talking about bills, like 30-day bills and 6-month bills, those things are super liquid. There's an active and thriving market. But when you go that far out in the yield curve, to say it's riskless, it requires a lot of caveats. Here you have SVB selling treasuries. They take a big hit. They file and they say, listen, we want to do a secondary stock offering, sell $2 billion worth of stocks to build up our capital again. And on, I think it was the 7th of March, news comes out that Silvergate Bank, it's a bank with close proximity to the cryptocurrency part of the tech industry. It announces it's going to voluntarily wind down. Terror. VCs immediately begin calling their portfolio firms, seeing Silvergate close down and seeing that SVB is trying to raise money. And basically what happens is, in a combination of VC firms calling their portfolio companies and talk on Twitter, people say, you got to get your money out of SVB. Get your money out. Immediately wire your money to another bank. So in the last 3 quarters of 2022, SVB lost 10, 11, and 4% of their deposits.
Wow.
On March 9th alone, $42 billion left the bank. That's a little over 40%.
Wow.
So SVB out of cash. They can't pay all of these people. This is the thing about fractional reserve banking. The proponents of it say, I'll use an example which is local to me. The George Washington Bridge is meant to carry a few thousand cars and trucks at one time, not the entire population of Manhattan or New Jersey. So all out panic, SVB stock gets halted, FDIC comes in, and they take over the business. They rename it the FDIC Bank of Santa Clara. And the depositors are told that your insured account amounts are going to be accessible on Monday, March 13th. So that's the first stage. That comes to the seizure of the bank. SVB had something like 37,000 accounts, most of which with balances vastly in excess of the deposit insurance limit, which is $250,000. You have in this bank a lot of tech bros and people who are brilliant with software and programming and all that sort of stuff. They're not finance guys. So I don't think they think, for any number of reasons, that this is even a possibility.
Before you go on in the story, I read recently that part of the problem was that SVB's CEO decided to be transparent about what was going on and announced that they were having liquidity problems, and that contributed to the run on the bank. Is that correct?
I think when they filed to show that they had taken a $1.8 billion loss on that sale and that they were trying to raise capital through a stock offering, the message that was sent was that they were having liquidity problems. Mm-hmm. I don't think it was that explicit, but I think that was the inference. And certainly by this time, the rumor mill is going.
Right.
And people are saying, I'm getting my money out. You can do what you want. And so again, you have this herding behavior. I'm sure there are some VC firms which are saying to all of our 300 portfolio firms, which could represent who knows how many billions of dollars, we'd like you to move your money to X bank, whatever. I'm sure that's what was happening. I think what's kind of interesting here is that people have asked, is this a systemic issue? And the answer is yes, but in a different way. SVB was not like Lehman Brothers or Bear Stearns. Not only is it a different type of financial institution, but also it doesn't have the swap lines and kinds of things where if it doesn't pay, it'll take other banks down with it. The systemic risk of SVB is that given the number of accounts and the amount of money that were held in accounts vastly over FDIC limits, if they only paid out $250,000 per account, something like $151 billion worth of deposits would have been locked up. Mm-hmm. What that means is that whether you are a tech firm, whether you're a cleaning firm that goes into the office after everybody leaves, whether you're a caterer, a law firm, an accounting firm, whatever, a lot of people are not going to be paid that week, or at least until the resolution of the bank reaches the point where some of those funds can be released. Typically, you're covered to $250,000, and then the bank has to be resolved, and they have to see what the recovery value is of that bank. It's actually in the FDIC rules that they can provide advances if it looks like the bank will reasonably be liquidated at a value to cover those excess amounts. That doesn't seem to be the case here. I think the decision to make the depositors whole has both re-election and public choice implications in it, but it's not strictly against the rules. I should mention that.
How is it not against the rules when every time I walk into a bank, I see the placard that says insured up to, and yet here we are where people did not pay enough attention to that. And now the taxpayer is going to be asked yet again to bail out a group of people who should have been better at reading things.
The answer to that lies in the existence of like general welfare clauses and emergency clauses and all sorts of government documents. they always leave themselves a sort of a relief valve, right? There's always a way they can sort of get out of it. The nature of regional banks being what they are, somebody at some point said, hey, there could be a situation where there's an area that's very concentrated. And if we lock up, a substantial amount of bank balances, we could wind up throwing an area into recession. And by the way, Silicon Valley provides a lot of tax revenue for the state of California. California's GDP is, last I checked, about the size of France's. And that has political implications written all over it, especially as we're dancing on the edge of a recession right now.
Now, the FDIC insures the deposits for just such an emergency. The bank goes under and the FDIC comes in and says, okay, you depositors, you can get your money back, supposedly up to $250,000.
Right.
Now, the FDIC is a federal entity. Are there private insurers that banks can contract with over and above FDIC limits?
I don't know about banking, but I do know in the securities industry there are. Mm-hmm. So I believe that, yes, there probably are private insurance entities that can do that. The best insurance entity is a good hedge. And I mean, they didn't even have hedges on.
Because if a private entity were insuring the bank, as opposed to the FDIC, the private entity would have had a profit incentive to watch what was going on there.
They would have absolutely had that incentive. I definitely have my faith in the stickler instincts of a private entity that was on the hook for this money. But I wonder how few entities out there, how few firms, even the stress tests that are done, how many of them took into account the fact that the Fed would raise rates the most they've ever been raised in a 12-month period. I think in the future, when those stress tests are done, that'll be in there. But that's the slow and painful accumulation of knowledge that happens in finance, unfortunately.
And I don't know if this is ever said out loud, but how many of them said, well, if it gets that bad, the government will bail us out?
But then one of them said, you know what the lesson of all this is, right? And I said, well, I can think of a bunch. And he said, no, the lesson is you always put your money in Citibank.
And that's really a demoralizing lesson to those of us who think that responsibility should matter for something.
I agree.
The one thing you haven't mentioned in my lifetime is the savings and loan fiasco. That seems to play, right?
And I wanted to point that out. James said that the depositors weren't paying attention, letting their accounts go over $250,000. The fact is, the government has trained people not to care about that limit, going all the way back to the 1980s, 90s, when it bailed out the savings and loans above the FSLIC's limit. Mm-hmm. And then in 2008, when it did the same thing, and now it does the same thing again.
Yeah, I mean, there's a direct line that runs from the Penn Central bailout to the Continental Illinois to the savings and loan issue I remember in the late 80s, early 90s, and then the bailout of the airlines after 9/11, and then 2008.
Right.
And now here, with these actions, we're seeing the road being paved for the next ones. One of the things that's come up in the last day or two is that in 2018, there was a relaxation of certain Dodd-Frank rules that allow, I think it's depository institutions that have less than $250 billion in assets to avoid the stress tests. Of course, it's become a political point that might have saved SVB. First of all, those stress tests probably wouldn't have tested for this. They will in the future. But usually the way that these stress tests work is that they take an event like the crash of 87. They say, okay, stocks did this, interest rates did that, yields on corporate bonds of various ratings, AAA, AA did this, and then they plug in your positions and they say, okay, here's what you would have made or lost. There was no scenario yet for what happened just over this last year.
So stress tests predict the past.
Exactly, yeah. You're only as good as the worst thing that happened over the last whatever.
But notice what you just said, that Congress had relaxed some of the stress test requirements.
Yep.
Now, I go back to this idea that if the insurer to the bank were not a federal entity, but a for-profit entity, that for-profit entity would have a profit incentive to make sure these stress tests are not only applied, but the tests themselves are tested to make sure that they're adequate, because if they aren't, the insurer that's a for-profit entity now ends up holding the bag.
I guarantee that their stress test would be a lot more rigorous.
Right.
And take into account far more circumstances than the ones we see in our rearview mirror. This is where I put on my trader's hat. There's no real test for negligence or incompetence. Doesn't exist. There's a process called immunization. Too soon, right? So immunization is where a bank hammers out their duration gap and they bring it in line. In this case, where you have these 25, 30-year bonds and you have these certain deposits, what they would have said is something along the following lines. They said, okay, what we need to do is we need to slowly move out of 25 and 30-year maturities, and we need to get into some 5, 7, 10 years. We need to spread out the book a little more in terms of maturities. And then we need to buy vanilla interest rate swaps. You have a fixed rate of return on these bonds. You swap that out. You pay to receive rates that float with interest rates. You've hedged as much as you can. The thing is that there's no stress test for that. But I guarantee you, a for-profit entity would have looked at this book and said, you're probably going to lose a little, and there's a 1%, 2%, 5% chance you could lose a lot or everything.
Is there a risk of this spreading? And you said something about there is a systemic risk here, but not what you think it is.
The systemic risk of SVB is the geographic one. I have a point related to this.
The regional, yeah, right.
This one bank can take out or render frozen and immutable almost all the businesses in Silicon Valley. That's the systemic risk in this case.
But that's limited there.
Right.
Are you suggesting this is not a problem that we can expect to spread to the rest of the banking system?
You're not going to see contagion or anything like that.
Okay.
Not like the risk of Lehman Brothers or Bear Stearns would take down every other entity, or long-term capital management. More and more people are forgetting that one in 1998, hedge fund that had all sorts of liquidity lines to firms all around the world. Not that kind of thing. I also think that just the incidence of institutions with depositor bases as narrow as SVB is probably pretty unlikely. But one of the silver linings here is that maybe we should start to reevaluate the whole concept of a regional bank. So regional banks are a product of an age where the local banker would know his local businesses and you could walk in and talk to him and all that stuff. I'm not sure that in the age of the internet, that this is really a concept that, let me just say, if the price of that sort of bank is having this sort of really fickle depositor base that's unpredictable, I think maybe we should re-examine the feasibility of regional banks. I would expect that over the next year or two, they're going to get sold to some of the majors.
It's interesting you raise that topic because in the past, and when I say the past, I'm talking a century or more into the past, regionally, we weren't as specialized as we are now. You had to have all sorts of different businesses in the same area simply because you couldn't move goods and services as cheaply as we can now. But now with being able to move goods and services so cheaply and with the internet economy, you can have a region that is, as in the case of SVB, that's entirely or very largely tech sector.
Yeah.
That kind of lack of economic diversification didn't exist a couple centuries ago.
Yeah, I think the very fact that $42 billion left the bank in a few hours shows that we don't need to be within walking distance of a banking office.
Right.
I think
exactly.
we proved right there that that it's kind of it's a four-dimensional business now.
Yeah.
It's a curious thing, right? Because it seems like the banking industry is learning a lesson that the United States military learned a long time ago. Back in World War II, when the Army Reserve units were all drawn from one town, you ran the risk of not having a young man left in town.
Yep.
Then they figured, okay, what we really need to do now is diversify this risk by drawing from all over the country for these individual units.
Right.
And that made perfect sense given likely outcomes during wartime. I think we've got likely outcomes in the banking sector too. It's probably time to learn that same lesson.
I wrote an article about this 2 or 3 days ago, and I also mentioned that I don't blame this entirely for what happened, but if you were to look at SVB's website a day or two before it collapsed, you saw really detailed disclosures about DEI, lots of charts and data on hiring practices, more information than I ever thought existed about their carbon footprint. Well, this is a bank. This is not a ball bearing factory or a vulcanizing plant. This bank is telling you about its carbon footprint. The economist in me, when I take off the trader hat and put on the economist hat, time and resources are limited. I think it's more than fair to ask whether some portion of the effort that went into all this could have gone into some very basic risk management software, maybe a textbook on the history of financial crises, something like that.
And not only that, Pete, but this was the darling of its world, right? There was a congratulations society around this bank. The feedback they were getting was that they were doing everything just so.
Yeah.
And here we are a week later and there's no money left.
For years, we've heard about this terrifying thing called the shadow banking market. This is exactly why the shadow banking market exists, because you have companies like Tesla and Apple and Facebook, Meta, whatever. And some of these firms are so big that they actually have trading desks, such as you would have seen at hedge funds or investment banks where I worked. And basically, you have these big firms that are sitting on $60 billion in cash, $40 billion in cash. So what do? They're not going to open up a couple of 100,000 accounts with $249,999 in each. What they do is they buy scores and scores of the largest denominations of treasury bills that exist. They go to Bank of New York and they get into the repo markets. In that way, their money is protected and they're earning a return. They're not having to move stuff around bank accounts, and they're definitely at that size not taking the risk that they're going to have $1 above the minimum FDIC insured levels.
Right.
So oddly, these companies do better with money than banks.
They do, yeah.
We don't have a history in this country of bailing out companies like Meta, but we do have one of bailing out banks.
Right. It's kind of funny. Like people say that Ford or General Motors are basically healthcare companies that make cars as a hobby.
Right.
Maybe we'll see Google or Meta as a bank that dabbles in social media or something.
Right.
Ask any depositor of SVB where they would have rather had their money on Friday night.
Now, you said something interesting that I want to just ask a question. You said $1 over the limit. Does that mean the entire account is not insured?
No.
Okay.
Just the amount in excess.
Just the dollar.
Yep.
I'm reminded of my time overseas when if you came back into the United States with $10,000.25, you lost $10,000.25.
Huh.
It's a shame we even have to ask that, but it's a good question to ask.
Yeah, no, it is kind of a shame, but I really expected the answer to be something other than the reasonable one that you gave.
I have a personal story about a bankruptcy. I was banking with one of the first, if not the first, internet banks, NetBank, back in the 1990s.
Yeah, I remember that one. Sure.
Yeah. And it went bankrupt. FDIC stepped in, but it was unlike what we're hearing with SVP. This was beautiful. I didn't hear word one about what was happening until I logged on a Friday night to check my account. And this big thing pops up that says the FDIC has taken over NetBank because it's insolvent.
Yeah.
Don't worry, your money's fine. It'll be accessible to you on Monday morning. And sure enough, I logged in Monday morning. What had happened was the FDIC had worked out in the background with NetBank. It got a buyer for NetBank. All of that turnover happened over the 48 hours of the weekend. You log in on Monday. All your accounts are there. It's under ING, which then subsequently went financially insolvent also some years later.
Yes.
But it was a beautiful handoff. I looked at that and thought, wow, that's exactly how this should work.
Yeah.
Did you just say something good about government?
Well, I said something good about that particular instance. But part of it is nobody knew, or at least speaking as a member of the public at large seemed not to know that this was in the offing. And so you didn't get a run. Now, had there been some announcement of, oh, look, NetBank's looking to be financially solvent, bet your bottom dollar I would have had all my money out of there within 10 minutes.
Yep.
I bet you were sweating it out for a weekend, wondering what the hell was going to happen.
Well, I was, particularly since it was the government saying, don't worry, we're going to give you your money.
Right.
Yeah, boy, it's hard to imagine a worse scenario than the government telling you not to worry.
Another thing, we're seeing right now what people like myself and some others at AI have spoken about. We've got a central bank with all these different mandates. Right now, the Fed has to decide what's more important, squashing inflation or keeping the financial system stable. I mean, just the knock-on effects of this are so numerous that I'll be dining out on this for the next 3 months. This is a meal for a quarter at least. There's a lot to write about and follow in this particular incident.
Pete, this has been wonderful. Thank you so much. We had a number of listeners ask for this episode, and you were a godsend.
Yeah, you really were.
Showing up, knowing exactly what we need to talk about.
Gosh.
We are hopelessly incompetent on this matter. Hopelessly. And unlike most academics, we decided to shut our mouths.
I really appreciate the opportunity. There's a lot of people who'd like to be on Words and Numbers, but I mean, like, when it comes to a bank failure or a securities firm blowing up or a hedge fund going over a cliff, I'm probably your guy if you want.
You are absolutely our guy. Thanks for doing it.
And that's all the time we've got this week on Words and Numbers. Until next time, be sure to follow us on Twitter. Handles are in the show notes. Join Words and Numbers Backstage, the Facebook group where the conversation continues, and
send us email, wordsandnumberspodcast@gmail.com.
Until next week, try to be nice to one person who doesn't deserve it. Just one. And who knows, it may turn into a trend. Give it a shot. You might feel good about yourself.
You could say you tried.
You tried. That's right. Till next week. Can't take it easy.
See you next week, James.